Welcome to the TU Markets Economics and Business Show. In this episode we will look at the UK housing market and why houses are as safe as a house of cards. In order to understand that we are on the verge of a housing crash, we need to look at why home prices are record highs. There are three main reasons behind this. The first one is the QE programme since 2008. When we had the global economic downturn in 2008, global central banks embarked on a money printing spree. And a lot of this money that got printed was funneled into the markets and into assets. And one of these areas was the UK housing market, which means it has pushed up the price of UK home prices. The second main reason is ultra low interest rates. When interest rates are low, people take out more mortgages and buy more homes. When interest rates are high, people take out less mortgages and buy less homes. So because interest rates have been ultra low, that means more mortgages have been taken out by home buyers, families, investors and developers. And a lot of this money, most of this money was pushed into the UK housing market. And that also contributed towards the increase of price. The third main reason is the UK tax haven status. It's no new news that the UK property market is a 21st century Swiss bank account because of our tax haven status and our banking system and its international dominance. Supply is not a problem. A lot of people and even the media portray it that the supply of housing is a problem. Nationwide, it's not, no, because we have over 200,000 empty homes across the whole of the United Kingdom. What we have is a regional supply problem, mainly in urban areas and cities. Manchester, Birmingham, and mainly London. But coastal towns, Hastings to Clacton to Bournemouth to places in Ipswich, they have a high supply of housing. So regional, yes, we do have a housing supply problem, mainly in urban areas and cities. But nationwide, we do not have a housing supply problem. We have over 200,000 empty homes that could house roughly 1% of the whole United Kingdom population. And let's look at the prices. Currently, as we speak, according to the Halifax Home Price Index, the average home price is £237,000. But the average UK wage is £28,000. So, the average UK home price is 8.5 times higher than the average UK wage, and this is unsustainable. Within the past 12 months, the UK housing market has entered a slow downturn, and the reality is very different from the media and the numbers, and a no-deal Brexit will not be good for the housing market. So, when and why will home prices crash? There are three reasons that will trigger a home price crash. The first is quantitative easing stopping. As I mentioned earlier, what helped to push up home prices was the QE programme since 2008, and when that stops or slows down, that will contribute towards the prices of homes falling. The second reason will be interest rates rising. There's currently £1.5 trillion in mortgage debt across the whole of the United Kingdom. So let's have a scenario where interest rates rise just 2% on half of this debt, £750 billion of this mortgage debt. That means an annual extra payout of £15 billion from mortgage holders just to pay interest rates. And that will hurt consumer spending power. because money will be directed from the economy into paying interest rates on mortgages across the whole of the United Kingdom if half of them were to increase by 2% in interest rate. And because consumer spending power will get hurt, that will then hurt companies' profits. And when companies' profits get hurt, the effect is usually workers are laid off or sacked. So interest rates rising on half of the total UK mortgage debt, the domino effect can go all the way to the unemployment figures. So it's quite a big thing. The third reason will be an economic slowdown, not just in the United Kingdom, but globally as well. Now let's look at the housing market in the form of stock market companies. There are a lot of housing companies out there where their share prices are not doing that well, and there are a few strong ones, yes. Let's look at the ones that are weak. Land Securities. The share price has fallen 18% in the past 4 months. Savills. The share price is down 10% in the past 2 months. Redrow. The price is down 15% in the past 6 months. Countrywide. The price is down 60% in the past year. Crest Nicholson. The price is down 46% in the past year. Foxtons. The price is down 30% since April. And Persimmon. The share price is down 20% on the year. And there are a few strong housing companies: HomeServe, Bellway, Berkeley, Barratt and Galliford Try. But we here at TU Markets are soon to short these because their prices are very high relative to the economic reality. Now us here at TU Markets, we predict a 35 to a 45% fall in home prices, with a nationwide fall of 40%. London taking the big hit up to 45%, and coastal towns and homes up north taking a smaller hit of around 35%. But nationwide, we believe there will be a 40% correction. And if the economy enters a depression stage, prices will fall over 50%. And when this occurs, the dreaded negative equity scenario comes into play. And then banks, investors, developers will be dumping thousands upon thousands of homes onto a market with literally no buyers. So, the main reasons why home prices are record highs are due to QE programs since 2008, ultra low interest rates, and the UK tax haven status. And the three main reasons why a housing crash will occur is the QE program since 2008 stopping or slowing down, interest rates rising, and a global economic downturn. Now, thanks for listening to the show, and feel free to check out our website and our private community for more details. And until the next show, have a prosperous and a profitable time. Bye.